Yes, sir.
Yes, sir.
So, these are all the five heads of income. We have done salaries. We are going to do today now capital gains. Okay. And then we will have income from house property, profit and gains from business and profession, and from other sources. So, let's start from here. Okay, so this is, a table. I'll just read out and then I'll ask Pratishtha to read whenever she has to read. So the table below shows how the capital assets are classified as short term or long term based on the holding period. Now, if you hold an asset, like suppose, what is a capital gain? So question is, what is the capital gains? When you buy a property or a share or a bond or a mutual fund and you sell it after some time, and you suppose bought it at 1 lakh rupees and you sold it at 2 lakh rupees, so you make a capital gain. Okay. And that difference of the profit which you have made is called the capital gains, and you are subject to pay tax on that. For example, let's say that you bought a piece of land for say 10 lakh rupees and you sold it after 5 years at say 20 lakh rupees or 25 lakh rupees. So which means you have made a capital gains of 15 lakhs and you are supposed to pay a tax on that. Now, under the head capital gains, it can be either a short-term capital gain or a long-term capital gain. Okay. So if you hold the asset for more than number of years, it becomes a long-term capital gain. If you hold it for only for a short period, then it's called a short-term capital gain. Okay. So now for each class of asset, it is defined differently. Okay. So for example, let's see, this is the capital asset and this is the holding period of the capital asset, short term and long term. So immovable property such as house property. Suppose you are holding a house property, okay, for less than 2 years, then it is a short term. If you hold a property for more than 2 years and then you sell it, then the money profit you make is called the long term gain. So that means any asset which you're holding, which is in the nature of house property, and you buy it and then you sell it after some time and sell it after 2 years, then you make a long-term capital gain. But if you sold it before 2 years, then you're making a short-term capital gain. Now, why we are making short-term and long-term? Because a long-term capital gain, you will be paying a lesser number of tax compared to a short-term. If you hold an asset for a short period of time, you have to pay more tax. But if you hold the asset for more number of years, the tax liability falls. So that's why there is a classification of short term and long term. And we'll understand that very shortly after this slide. So any immovable property, that means if you hold a house property for more than 2 years, what will be long term, short term? Tejasvi? Kishore?
Yes, sir.
If you are holding a property, a house property for more than 3 years and you are selling it after that and making a capital gain, will it be a short term capital gain or a long term capital gain?
It is a
It's a
long
long
term, sir.
term.
Long term. Okay. Now, movable property such as gold or jewelry. Now, for gold or jewelry, they are movable property. So you have to hold more than 3 years to classify as a long term. If you buy a gold and then you sell it, say after 2 years or less than 3 years, then any gain which arrives to you is called a short term capital gain. Now, shares which are listed shares, like the shares which are listed on the Bombay Stock Exchange or National Stock Exchange, they are called listed shares. So there, the holding period is more than 1 year. If you hold for more than 1 year, then whatever capital gain you make is called long-term capital gain. Otherwise, you'll be making a short-term capital gain. Equity-oriented mutual fund. Now, either you can buy shares or you can buy mutual funds which invest in shares. Okay. Now, if it is shares which are, if it is mutual fund which is holding only shares, okay, then, the period is similar to the listed shares. That means if you hold mutual funds for more than 1 year, then they will be classified as long-term capital gains. But they should be equity-oriented mutual funds. Okay. So equity-oriented mutual fund means that means where more than 65% of the money is being invested in equity shares. Okay. So I've given a link, so you can just go to the link and understand what are equity mutual funds. Then the third last category is debt-oriented mutual funds. That means if you're holding mutual funds where the money has been invested into, debt funds, then the period is more than 3 years to qualify as a long-term capital gain. So let's understand. Now I'm just skipping that. Read this, Tejasvi. Kajal, are you there?
Sir.
Okay. Just read.
Rate of long-term tax on sale of immovable property. As per Section 112 of the Income Tax Act, long-term capital gain on the sale of immovable property in India is taxable at 20% with an indexation benefit.
Now, the rates of income tax are given under the Income Tax Act. Okay, as far as the capital gains are concerned, whereas for all other tax rates are given under the Finance Act, which is passed by the every year in the Parliament. So the Finance Act, all the tax
Sir,
other
can
than
you repeat this line once again?
what I'm saying is that all the tax rates, like when you want to know what is the tax rate, all the tax rates are decided at the time of finalization of budget. So whenever the finance minister is passing the budget, he or she passes a Finance Act, okay, and
Hmm.
all the rates are given under the Finance Act, okay, but only the exception is capital gains tax. The capital gains tax are rates are given under the Income Tax Act. Have you got it?
Okay.
There are
Yes,
all
sir.
the tax rates are given under Income Tax Act, all the capital gains. But other than the capital gains, they are given under the Finance Act because every year the rates of taxes change or they are bound to change. Okay, but so they are kept under the Finance Act. Whereas capital gains can also change, but then they have to amend the act. Okay, fine. So just let's see that the capital gains tax on immovable property. For example, if you are selling a land, building, or anything which is called the immovable property, and it is a long-term capital asset, then the tax rate is 20%. Okay, fine, and you are also entitled for indexation benefit. So we'll understand what is indexation benefit shortly. So the rate for long-term capital gain is 20%. Okay, whatever may be your income tax bracket, you may fall under 30% tax bracket. I mean, normally for your other income, but you have to pay only 20% tax under the long-term capital gains tax if it is long-term immovable property. Read this now, Kajal.
Rate of long-term tax on sale of equity shares and unit of equity-oriented funds. Section 112A provides for long-term capital gains tax on the sale of listed equity shares, equity-oriented mutual funds. The rate of long-term capital gain tax on these listed security is 10% for gains exceeding the threshold of rupees 1 lakh.
So if you are holding equity shares or mutual funds, which are equity oriented mutual funds, and if you sell them after 1 year, so they will be classified as long-term, assets. And if you sell them after 1 year and you make a capital gain up to 1 lakh, you don't have to pay any tax. Beyond 1 lakh, you are supposed to pay a tax of 10%. For example, just listen to me very carefully. Suppose you bought a shares of 1 lakh rupees of Reliance, and after 5 years or after 3 years, the value of these shares is 5 lakhs. So what is the capital gain you have made? So you bought Reliance shares of 1 lakh. You bought them about 3 years back, and today they are valuing 5 lakhs. Okay. So what is the
4
gain?
lakhs.
4 lakh
4
4
lakhs is
lakhs.
a
capital
long-term
gains.
capital gains because you are making it after 3 years. Now, so 4 lakh is capital gains. So how much will be exempt?
1 lakh.
How much is taxable?
3 lakh.
And what is the tax you have to pay?
30,000, sir.
30,000 plus the cess. Okay, so this is,
Sir.
yeah, long term. Is it clear to everyone?
Yes, sir.
Okay. Now read this, Kajal.
Rate of short-term tax on sale of equity shares and units of equity-oriented funds. Short-term capital gain arising on transfer of listed equity shares, units of equity-oriented fund, 15%.
So that means if you bought shares or you bought mutual funds, say for example, you bought shares of 1 lakh rupees of Reliance, and say after 10 months you sold those shares for 2 lakhs. Okay. So what is your capital gain, Kajal?
1 lakh.
And how much tax you are supposed to pay?
15,000.
15,000, yeah. And there is no 1 lakh limit here. So if it's a short-term capital gain, then there is no exemption up to 1 lakh. You have to pay straight away 15% tax. Even if you may fall under 10% tax bracket rate, but a short-term capital gain tax is 15%. Even if you fall under 20% or 30%, you have to pay only 15%. So there is a fixed rate of tax for short-term capital gain on sale of equity shares or mutual funds which are invested into equity. Is this clear?
Yes, sir.
Okay. So now we understand what is a capital gain. Okay. Fine. Normally we should have read it first, but let's read it now. Read this, Kajal.
Section 45 Capital Gains. Section 45 provides that any profit or gains arising from the transfer of a capital asset effected in the previous year will be chargeable to income tax under the head Capital Gains.
So now section 45 is a charging section. This gives powers to the central government to tax, okay, for any profit or gains arising on transfer of capital asset. Okay. So if you have sold something in the previous year, then you are supposed to pay a tax which is called the capital gains tax, okay, on transfer of the capital uh, asset. Read further.
Such capital gains will be deemed to be the income of the previous year in which the transfer took place.
So that means, if you sold them or you transferred them in the last year, so you have to pay a capital gains tax. Okay, it will be considered as the income of the previous year in which you sold it. Okay, fine.
In this charging section, two terms are important. One is capital asset and the other is transfer.
So the word is used capital asset. First of all, what you are selling should be a capital asset. Okay, fine. If it is not a capital asset, then you can't be charged capital gains. Number two, it should be transfer. So the word transfer they have used, not sale. Okay, fine. So the sale includes transfer, but we'll understand the definition of transfer later on. First, we understand the definition of capital asset. Read this.
Capital asset, property of any kind held by an assessee, whether or not connected with his business or profession.
So that means if you're holding any asset, okay, which is either your business asset or it's your personal asset, okay, it's called a capital asset, whether it is connected with your business or profession or whether not, so it is called capital asset. However, okay, read this.
However, it does not include stock in trade,
Okay, which means that if you are doing a business, then whatever your stock which is there in your business is not when you're selling your stock and making a profit, it's not a capital gain. It's your profit from business. Like suppose you're doing a garment business and you have got a lot of garments inventory with you. Suppose you are having a showroom or a shop, so a lot of garments are your stock in trade. So when you buy or sell garment which is your stock in trade, it is not going to be subject to capital gains. It is going to be subject to income from business or profession. Okay, so it doesn't include stock in trade. Okay, because it is taxable under the head income from business or profession. Again,
assets held for personal use, excluding jewelry, drawing, painting, etc.
so any asset which you are holding for personal use, like suppose you have some furniture, a car, if you sell them, now there is no capital gain on such asset because they are personal use assets, but it excludes jewelry, drawings and paintings. So jewelry can be your personal, you can using for personal purposes, or drawings and paintings which you buy for your house, I mean decoration purposes. So if you buy and sell them, then they are considered as capital assets and you are supposed to pay tax on them. But apart from this, any other personal asset which you are buying and selling, there is no capital gains.
Rural agricultural land.
So if you are having an agricultural land and you are selling it, it is exempt under the capital gain. So you don't have to pay any capital gains if you are buying or selling agricultural land, which is a rural agricultural land defined by the income tax.
Specified gold bonds.
So some gold bonds have been specified, which have been also been excluded out of the definition of capital gains. So you don't have to pay, if they are making a profit on capital gold bonds. Okay. Now, short term and long term. Just read this.
Short-term and long-term capital asset. Short-term capital asset means a capital asset held by an assessee for not more than 36 months immediately preceding the date of its transfer. A capital asset held by an assessee for more than 36 months immediately preceding the date of its transfer is a long-term capital asset.
So this is a general definition. Of course, we have seen that for stocks and other things, the number of period has been shortened. Okay. So this is a normal, life that if you're holding an asset for less than 36 months and then you are selling it or transferring it, then if you make a gain, it's called the short-term capital gain. But if you are selling it after 36 months, it becomes a long-term. But of course, there are exceptions. Exceptions are, read them.
Exceptions: a security listed in a recognized stock exchange, shares, unity of an equity-oriented fund, mutual funds, units of the Unit Trust of India, zero-coupon bonds, will however be considered as a long-term capital asset if the same is held for more than 12 months immediately preceding the date of its transfer.
So that means the shares, the mutual funds which are equity oriented, or the units of the UTI or zero coupon bond, they are all assets. If you hold them for more than 1 year, they will be called a long term. So this is an exception out of the general formula what we have seen in our last slide. So which we have already covered in my first slide. So assets, shares and mutual funds, you can hold them for 1 year and sell them after 1 year. They will be called as long term capital gains. Then
Exceptions: further, an immovable property, being land or building or both, would be treated as a short-term capital asset if it was held by an assessee for not more than 24 months immediately preceding the date of its transfer.
so that means there is another exception, which is land or building. That means all the immovable property, if you're holding them for less than 24 months and sell them thereafter or transfer them, so it will be called as short term. But if you sell them after 24 months, any gain arising will be called long term. Okay.
Thus, the period of holding of an immovable property, being land or building or both, for being treated as a long-term capital asset would be more than 24 months instead of more than 36 months.
Okay, so the general definition is 36 months. So for immovable property like land or building, the period has been reduced to 24 months. Similarly, for shares, the period has been reduced to 12 months. For all other assets, the period is 36 months. For gold, for jewelry and everything, it's 36 months. For debentures or for mutual funds, debt-oriented mutual funds, the period is 36 months. Okay, so because if you can just go to the slide again here and read this, then you will understand. Okay, so if you see, the various assets and short term, long term, which we did at the beginning, this is like equity oriented mutual fund, which is the last second, less than 1 year, more than 1 year. Immovable property, less than 2 years, more than 2 years. So this whole chart has been made from that definition which we have just concluded in our this thing. So I'm just going back. You can just go through later on again if you want, and let's proceed further. Okay, so this we have done, this we have done. हाँ, just read this. हाँ, ये तो हमने कर दिया था. Okay, हाँ, just read this.
Mode of computation of capital gains, section 48. The income chargeable under the head capital gains shall be computed by deducting the following items from the full value of the consideration received or accruing as a result of the transfer of the capital asset. Expenditure incurred wholly or exclusively in connection with such transfer, brokerage, etc., the cost of acquisition and cost of any improvement thereto.
For example, you sold a property, you sold a building, you bought it for 5 lakhs. Okay, you bought it for say 50 lakh rupees. So this is the value of the consideration. That means you are selling it for. Suppose you bought it at say 5 lakhs. Okay, so cost of acquisition. So cost of acquisition is 5 lakhs. You sold it for say 50 lakh rupees. Okay, when you sell a building, which is, suppose I just repeat this example again. Suppose you had a building and you sold it for 50 lakhs. Okay, because when you sell the building for 50 lakhs, you have to approach a property consultant or a broker. So you need to pay a brokerage also. Okay, suppose you paid a brokerage of 1 lakh rupees. So that means your net consideration will be 49 lakhs. 50 lakhs minus the brokerage. So that means 49 lakh rupees you have received. What was the price at which you bought the building is the cost of acquisition. Suppose you bought this at 25 lakhs, which means 24 lakhs would be your capital gain. So I'll do some questions also. So just read before this, we understand this through some more illustrations later on. Just read that.
Cost inflation index. Under section 48 for computation of long-term capital gains, the cost of acquisition and cost of improvement will be increased by applying the cost inflation index. Once the cost inflation index is applied to the cost of acquisition and cost of improvement, it becomes indexed cost of acquisition and indexed cost of improvement.
Okay, so I'll just show you. This is the the cost of inflation index, which is published by the income tax department every year. Okay, so it starts from which year? 2001, 2002, when the index was 100. So that was the beginning year. And what is the level as of 2023-24, which has just concluded? 348. Okay, so that means if you bought something at 100 rupees and today in 2001, 2002, and you're selling at 348, so you're making a profit of how much? 248. So you don't have to pay any tax on that. Okay, so this chart takes care of what almost like on an average 5.8% inflation has been inbuilt into on an average. The index has been going up at 5.8% per annum. Okay, so this is your index, inflation index. Just to give an example, suppose you bought a property in 2001, 2002 for 1 lakh rupees. Okay, and today suppose you are selling that property at 3 lakh 48,000. Okay, so what is your capital gain?
So can you repeat?
Suppose
Sir,
you
two
bought
lakh 48,000.
suppose you bought a property of say for 1 lakh. In which year? 2001, 2002. Okay, and you sold that property
Hmm.
for say 4 lakh rupees in on 31st of March 2024. That means just a month back on 31st March you sold that for 4 lakhs. So what is your capital gain
Sir,
before
3 lakh.
indexation? 3 lakhs.
3 lakh.
Okay, now 3 lakhs is your capital gain, isn't it? But what will I'm going to do? I'm going to do is 348 divided by 100 into 1 lakh. So it will become 3 lakh 48,000. So now what is my capital gain? 52,000.
52,000, sir.
Yeah, because you will get a indexation benefit because 1 lakh has become equivalent to 3 lakh 48,000. So your cost,
48,000.
Yes, sir.
yeah, your 100 rupees has become 3 lakh 48,000. So that means you are selling a property at 4 lakhs, which is equivalent to 3 lakh 48,000. So you don't have to take the original cost. You have to take the cost of
Index cost.
index cost. So it will be 3 lakh 48,000. So that means you make a gain of, so I'll just put it again here for the students who have not understood. For example, 2001, 2002, 2000, let's see, exit, 2001, 2002, 2001 dash 2002. The index was 100. Okay. And the index in 2003 24 is how much? 348. Okay, so this is the index. Right on 2001, 2002, the index was 100. And now the index is 3,48,000. Suppose you bought a property, say, for 1 lakh in the year 2001, 2002. Okay, and you sold this property, sale you did it at, say, 5 lakhs. Okay, fine. So what you are going to do, this is your cost. So you are going to calculate the index cost, which will be this, this divided by this into this. Fine. So your index cost will be 3,48,000. So your capital gain will be Read the difference of that.
So 1,52,000.
Yeah. 5 minus 1,52,000. Yeah, absolutely right. Is that okay? Suppose you bought this property in, say, 2018, 19. Fine. So in that case, this figure will change. Okay. This figure is changed, and then we are going to look at 2018-19. So what was the number 2018-19? 280. 2018-19, was it 2018-19? 280. So 280. So I'm going to take figure 280. So in that case, indexation cost will be only 1,24,000. The capital gain will be 3,75,000. Is that clear to everyone?
Yes, sir.
Anybody who has not followed, please ask me. I'll repeat again. Okay. Anyway, we will be doing a lot of questions, so you'll be able to understand them as we go along. Okay. So read this, Kajal.
Cost of inflation index. The base year is the first year of the cost inflation index and has an index value of 100. The index of all other years is compared to the base year to see the increase in inflation percentage. For any capital asset purchased before the base year of the cost inflation index, taxpayers can take the purchase price higher of the actual cost or fair market value as on the first day of the base year. Indexation benefit is applied to the purchase price so calculated. Fair market value is based on the valuation report of a registered valuer.
Now, if you bought a property which was before 2001, 2002, because this index starts from 2001, 2002. Suppose you bought a property in 1995. Now, you can't use this table here, isn't it? So, in that case, if you have bought a property before 2001, then you have to get it a fair market value. What is the fair market value as on 2001, 2002? Okay. So, you go to a valuer, okay, and he will tell you what is the market value of that property on 2001, 2002, and take that market value and apply the same formula. Like, for example, let's say, let's see, come back to this question again. Suppose you bought a property. So I'm just going to change first here to this. Okay, and make it 100 here. Fine. Suppose you bought a property in 1994, 95. Okay, you bought a property and the cost was, say, 75,000. Okay, fine. Now you will go to the valuer and suppose this is a land, for example, this is a land. Fine. Or this can be even a building. So I can take either a land, a building, or whatever. Suppose this is a building. Now you go to a valuer, okay, who is called the registered valuer. So they are registered under the Income Tax Act. Okay, so they apply to the income tax authorities and get a certificate. Okay, once they have got a certificate, so there are many people in your, every state they are there. So you can even go online to them. So you go to the registered valuer. So he will tell you what is the value of this building as on 2001, 2002. Suppose they say the value is 2,50,000. So you bought at 75,000, but the value on the fair market value, I will say fair market value, because after you bought in 1994, but you have to trying to find the value. What is the value on 2001, 2002? So he'll give you a fair market value. So he says the value of this property is now 2,50,000. So you are going to take the cost as 2,50,000. So you are going to substitute this with this. Okay, fine. And suppose you have sold it, say, for say 9 lakhs, for example. So then the index cost will be 8,70,000. Okay, and that means you made a you sold at 9 lakhs. Of course, you bought this property at 75,000. You sold at 9 lakhs. Okay, but your capital gains would be only. This is the capital gain. So your capital gain will be only 30,000. How? Should I explain it again? Okay, just listen to it again. Suppose you bought a property, okay, a building in 1994, okay, and it cost you say 75,000. Now you have sold it for 9 lakhs in 2024, 2023, 24. You sold it, okay, you sold it in 2000 for 9 lakhs. Now you will go to the valuer and he will tell you the value of this building as on 2001, 2002 is 2.5 lakhs. Then you are going to put this as a cost and then apply the indexation benefit. In 2001, 2002, the index was 100 and in 2023, 24, the index is 348. So that means the index cost will be 870. Is that okay? Fine. So this is your index cost. You have sold at 9 lakhs. The cost is 870. Your capital gain will be only 30,000. And suppose you have to pay a tax. The tax is 20%. As you know that long-term capital gain is 20%. So you are supposed to pay a tax of 6,000. Is it all okay? You got it?
Yes, sir.
Suppose the valuation was, for example, not 2,50,000 but 1,50,000. So in that case, your tax will be 75,600 because in that case you are going to make a capital gain of 3,78,000. Is it clear?
Yes, sir.
Okay.
Yes.
So anyway, we will be doing some more questions. Okay. So don't worry. This all exercise we will be doing again. So is this clear? Ajal, can you read the third, fourth, and fifth box?
Yes, sir. For any capital asset purchased before the base year of the cost inflation index, taxpayers can take the purchase price higher of the actual cost of fair market value as on the first day of the base year. Indexation benefit is applied to the purchase price so calculated. Fair market value is based on the valuation report of a registered valuer.
Okay. So you go to the registered valuer. He will give you the value and apply that. Yeah. Any questions coming? Okay. Is that clear to everyone? Okay. Points to ponder. Read this.
Points to ponder. In case of property received in the will, CII has to be taken from the year in which the property is received. The actual purchase year of the property has to be ignored.
Now, if suppose you have got the property through will. For example, my father died, he made a will. So he purchased the property in 1960, but I got that property in say 1990. So the year from which I am entitled for the cost of inflation index will be from say, for example, I got it in 2005. So I have to take it 2005 as the year on which I can apply the cost of inflation index and not the 1960. Okay, fine. So in case of property which is received in will, let me just give you more example. Okay, let's just give the example here. Suppose my father died in the year 2000. Sorry, my father acquired a property in 2003, 2004. Okay, so he bought the property in 2003, 2004, and he died in the year 2010 and 11. Okay, and I got that property in my name. It was transferred in my name because I was the sole heir of my father. So the property came to me in 2010, 11, and I sold that property in 2023, 24. Then the year of indexation will be 2010 and 11, and not say 2000 when he bought the property. Is that clear? So when I got the property through will, the year will be taken for applying the cost of inflation index will be when the property became the property of the new owner. After the will, who became the new owner, his son. So that year will be taken and not the year in which your parents bought the property. Okay, so that is what is written here. Okay, just read this again.
In case of property received in the will, CII has to be taken from the year in which the property is received. The actual purchase year of the property has to be ignored.
So that means CIA stands for cost of inflation index. So when I'm getting the property through will, so the year in which I got the property in my name, that year will be counted, not the year when the property was actually purchased. Okay.
Ignore the improvement cost incurred before 1st April 2001.
If the property is very old and you have done some kind of an improvement, suppose you bought a property and you did some improvements, you made another one floor. So any cost which you have incurred had to be ignored. So we'll understand this through an example. Okay, fine. So let's do some question. Okay, just read this question.
Case 1. Rahul purchased a flat in financial year 2001-2 for rupees 10 lakhs. He sells the flat in financial year 2017-18. What will be the indexed cost of acquisition? In this case, CII for the year 2001-2 and 17-18 is 100 and 272 respectively. Hence, the index cost of acquisition is going to be 10 lakh into 10 lakh into divided 272 divided by 100 equals to 27 lakh 20,000.
So which means, the property was purchased in 2001, 2002 when the index was 100. But in 2017 to 18, the index is 272. So that means the cost of indexation or the cost of, acquisition of property will be considered not as 10 lakh, but 27 lakh 20,000. So what we are going to do is, we are going to multiply 10 lakhs into 272 divided by 100. So we'll have 27 lakh 20,000. So this is the index cost of acquisition. Okay, is that clear to everyone? Kishore,
Yes. Yes, sir.
Kajal,
Yes, sir. Yes, sir. Yes, sir.
Pratishta, everyone. Okay, so this is simple. Second case.
Shivani purchased a capital asset in financial year 1995-96 for rupees 2 lakhs. Fair market value of the capital asset on 1st April 2001 was 3 lakhs 20,000. She sells the asset in financial year 2016-17. What is the indexed cost of acquisition?
Okay, read this.
Here the asset is purchased before the base year, hence the cost of acquisition is equal to higher of the actual cost or fair market value on 1st April 2001. That is cost of acquisition equals to 3,20,000. CII for the year 2001-2 and 16-17 is 100 and 264 respectively. Index cost of acquisition is equal to 3,20,000 into 264 divided by 100 equal to 8,44,800.
So is that okay? This property was bought for what price? For 2 lakhs. But
Hmm.
it was bought in 1995. But
Hmm.
on 1st April, the fair market value is 3,20,000. So here, she will take 3,20,000 as the cost of acquisition and apply the indexation benefit from the base year till the year which year she has sold, which is 2016-17. So that means the cost of acquisition will be 8,44,800. Kishore, have you followed? All of you, please confirm. Who has not followed, please let me know. Is it clear? Kajal?
Yes, sir. Yes, sir. Yes, sir.
Okay, now let's come to this.
Case 3. Shivani purchased a capital asset in financial year 1995-96 for rupees 2 lakh. Fair market value of the capital asset on 1st April 2001 was 3 lakh 20,000. Stamp duty value was rupees 3 lakh 5,000.
Okay, now there are three values. The value at which the Shivani has bought this property way back in 1995, 2 lakhs. The fair market value, which was done by the registered value, he says that the value is 3,20,000. But there is a stamp duty value. Okay, whenever you buy or sell land, you have to go to the registrar. Okay, the registrar will, you have to pay stamp duty whenever you sell the property. or you buy the property. Okay, so in every place in India, there is a stamp duty value which is determined on which you are supposed to pay the stamp duty. So in the municipal records, the value is given as per the municipal authorities, and that value is called the stamp value. So that value is taken for paying the stamp duty. So in this case, the stamp value is 3,05,000. So in this case, the stamp duty value, if it is less than the fair market value, then the stamp duty value will become the value at which you have to apply the indexation benefit and not 3,20,000. Okay, just read this.
She sells the asset in financial year 16-17. What is the index cost of acquisition? Here the asset is purchased before the base year, hence the cost of acquisition is equal to higher of the actual cost of fair market value on 1st April 2001, but shall not exceed stamp duty value. That is, cost of acquisition is equal to 3,05,000. CII for the year 2001-2 and 2016-17 is 100 and 264 respectively. Index cost of acquisition is equal to 3,05,000 into 264 divided by 100 equals to 8,05,200.
So basically here, you have to look at the stamp value. If the stamp value is available, if it is not available, then you go for fair market value.
So
Okay.
how do we get the stamp duty value?
I'll just tell you that.
From
That's a very
municipal
important.
corporation.
From the circle. Okay.
Circle rate.
Okay. Just read this first. Read this, Kishore.
Cost of acquisition of certain assets at a glance, where such capital assets became the property of the SSC before 1/4/2001. Cost of the asset to the SSC or fair market value as on 1 April 2001 at the option of the SSC. However, in case of capital asset being land or building FMV as on 1st April 2001 shall not exceed stamp duty value as on 1st April 2001.
Okay. So Kishore, whenever you are, you have purchased some asset, either land or building, and you go to the, because you have bought it from someone. Suppose you bought it from me. Okay.
Mhm.
The land building is in my name, and you gave me the money. Suppose you gave me 1 lakh rupees of say 50 lakh rupees, and I said you give me 50 lakhs and you take the property from me. Okay. Now we went to the registrar because the property has to change name from my name to your name. Okay. So we both have to go to the registrar.
Yes.
Now registrar will say that before the property is getting registered, you have to pay a stamp duty, which is around, say, for example, in Gurgaon, close to about say 5%. It's 6% now, but let's say it's 5%. So on 50 lakh rupees,
Okay.
6%, let's say 6%, which is the exact rate today. So when you buy this property, you have to pay 6% stamp duty. Okay. So that means you have to pay 3 lakh rupees. So cost to you will be 53 lakhs, isn't it? 50 lakhs you gave to me, 3 lakhs you paid to the registrar as stamp duty
Yes,
because
sir.
the stamp duty is 6%. Is that okay? Fine.
Yes, sir.
Now, the registrar, before applying the stamp duty rate, he'll check the rate. He'll check the stamp duty value. Now, he says that value of this property is not 50 lakhs according to his records as per it's called circle rates. The
Hmm.
municipal corporation, they publish the rates for each piece of, for each, sector
Each
or
areas.
each area. So they say that the value of this property should be 60 lakhs and not 50 lakhs, which means that you are taking somebody's trying to take cash from you and you are paying only 50 lakhs, though you are actually, so he will this is to curb black money. Okay, so he says that you have to pay stamp duty on 60 lakhs and not 50 lakhs. Okay,
Okay.
fine. So that is called the stamp duty value. So if is as per record, if the stamp duty value is 50 lakhs, then he will just, you have to pay 3 lakh rupees and pay the stamp duty, and the property will be registered in your name. But if the registrar
Hmm.
finds that the stamp duty value is different, so he will ask you to pay higher stamp duty based on higher value. Okay, so we'll discuss this further more, but stamp duty value is given at the time when you buy or sell properties and you go to the registrar, you have to pay the stamp duty before the property is transferred in your name. Okay, fine. So in
Yes, sir.
that case,
But sir, generally circle rate are less than the actual property rate.
Generally the circle rates are less than the property rates,
Actual.
definitely, because the property rates are always higher. Okay,
Yes, sir.
fine, but that's okay. If the circle rates are lower, then and you are registering at a higher price, so the stamp authorities will be happier to collect more tax from you. Okay,
Yes,
but
sir.
if you are showing a lower value, then you have to pay the stamp duty at the circle rates. Is that okay?
Yes, sir.
Okay, who was saying that?
So, Arvind.
Arvind. Okay, so you know about that. Okay, and your father
Yes.
is in real estate or what?
No, sir.
How do you know that?
So I know generally.
Okay, okay, fine. So let's go to the case number 3. Okay, ये हो गया था हमारा. Okay, case number 4. Okay, just read this, Kajal.
Example: Mrs. Shivangi purchases a house on June 6, 2018 for rupees 7 lakh. She spends additional rupees 1 lakh on furnishing in June 2020. She sells her house for rupees 20 lakhs on March 9th, 2023. Transfer expenses rupees 20 lakh, 20,000.
20,000. So Shivani has purchased the house on 6th June 2018 for 7 lakhs, and she has spent another 1 lakh rupees in furnishing the house in June 2020. She sells the house for 20 lakhs on 9th March 2023, and transfer expenses are 20,000. So in this case, so this will be the calculation. So sale consideration on March 9th, 20 lakh rupees, so which is given here, 20 lakhs he is selling, and then transfer expenses 20,000, so this will be reduced. Okay, less index cost of acquisition. So where when the property was sold in 22-23, the index was 331. So 331 divided by the index on 2018-19, which is 280. So the cost of acquisition will be 8,27,500. So what we have done, because he bought this property in June 6th, 2018, okay, which was 2018-19, where the index was 280. So 280, and when he sold, it was 331 year 2022-23. She sold on 9th of March, which falls under 22-23. So that means 331 divided by 280 into 7 lakhs. So it will become 8,27,500. Then she has done some improvements also. So those improvements will also be considered as will be added to the cost of acquisition. Okay. So she had done the improvement in June 20. So which is 2021. So we look at 2021, 301. So 331 divided by 301, improvement for 1 lakh. So that means the cost of improvement will be, index cost of improvement will be 1,09,000. So total capital gains will be 20 lakhs minus 20,000 minus 827 minus this and minus this. Is this clear to everyone?
Yes, sir.
Yes, sir.
Clear? Okay. Okay. So let's go back to this. Just read this, Kajal.
Ascertainment of cost in specified circumstances, Section 49. A person becomes the owner of a capital asset not only by purchase but also by several other methods. Section 49 gives guideline as to how to compute the cost under different circumstances.
So, when you buy a property, you become the owner. Sometimes you don't have to buy a property to become the owner. You can inherit from your parents under a will, or somebody can give you a gift. Okay. So, in the following cases, just read this.
Cost to previous owner deemed as cost of acquisition of asset.
Okay. Now, in this case, whosoever bought previously will be the cost. The asset will be cost of to the previous owner deemed to be the cost of the acquisition of the asset. Here, what we are saying is the person who bought previously, that cost will become the cost of acquisition. Okay, under certain circumstances. In following cases, read this.
In the following cases, the cost of acquisition of the asset shall be deemed to be cost for which the previous owner of the property acquired it.
For example, if my father acquired the property at say certain price, so that price will become the cost, and he gifted me that property, or when he died, he willed the property in my favor. I got it, so the cost will remain the same, the cost to my father. okay, of the previous owner.
To this cost, the cost of improvement to the asset incurred by the previous owner or the SSC must be added.
Okay, so thereafter, if there is any other cost which has been incurred either by my father before he willed the property to me, or after the property became my property by way of will, and if I did some improvements, those improvements will be also the cost will be added, and the index cost will go up at the time when I sell the property. Just read.
Where the capital asset became the property of the SSC. On any distribution of asset on partition of a Hindu
Undivided
undivided
family.
family.
Now, it can be like, there can be an HUF. So when there's a partition of HUF, sometime, you receive your property. So if you have got the property by way of partitioning of your HUF property, so that in that case also the cost of previous owner will be considered as the cost. Okay.
Under a gift or will, by succession inheritance.
So under the three cases, the cost to the previous owner will be considered as a cost of acquisition. Fine. So let's take an example. Last example before we close the day. Just read this.
Example, X and Sons Hindu undivided family purchased a land for rupees 1,20,000 in previous year 2002-2003. In the previous year 2006-7, a partition took place when Mr. A
Co-partner,
co-partner
co-partner,
co-partner
co-partner.
co-partner is allotted this plot valued at rupees 1,50,000. In previous year 2007-8, he had incurred expense of rupees 2,35,000 towards fencing of the plot. Mr. A sells this plot of land for rupees 15 lakh in previous year 2003 to 24 after incurring expenses to the extent of rupees 20,000. You are required to compute the capital gain for the assessment year 2004-2005.
Okay, so there was a HUF, X and Sons. Okay, so a partition took place. So they had purchased the land for 1,20,000 way back in 2002-2003. So in 2006-2007, when the partition took place, a co-parcener, that means he would be a lineal descendant of this HUF. Okay, like suppose I told you that I have a HUF in my HUF, myself, my son, my daughter, and my wife. They are all co-partners. I am the karta, and they are co-partner. Suppose one of the property which belonged to me, the HUF became the property of my son, and we had a partition. So I gave the property to him. Okay, so it can happen like this. So in previous year 2006-7, a partition took place when Mr. A co-partner, allotted a plot valued of 1,50,000. So this plot was purchased at 1,20,000 way back in 2002-2003. Okay, so in the previous year 2007-8, he had incurred an expense of 2,35,000 for fencing the plot. Okay, for making a boundary or to securing that this thing. Then he sold this plot for 15 lakhs in 2023-24 after incurring an expense of say 20,000. So you are calculate. So now this will be the sale consideration how much? 15 lakhs. Expenses how much? 20,000. So what is the cost of indexation? 1,20,000 into 348. 348 is basically, if you look at in 2023-24, the the value, the cost of inflation is 348. So 348 divided by 322. 322 is 2006-2007. So the property became the property of the co-partner in 2006-2007, which is 122. Okay. So the index cost will be the cost to the HUF. What was the cost to the HUF? 1,20,000. Previous owner. Okay. Fine. But we are not taking 2002, but we are taking 2006-2007 when the property became the property of Mr. A. So the indexation benefit will be applied from the year when the property became the property of the co-partner into the value today. So 1,20,000 becomes a value as 3,42,095. The index cost of improvement will be 2,35,000. That means he has spent, 2,35,000 in 2007, 2008. So in that case, 2007, 8, the index was 129 and now it is 348. So 348 divided by 129. So that means it will become 6,33,000. So total cost of indexation will be 9,76,000. So long-term capital gain will be this minus this. Okay. Now just read this. Kadir.
Note, as per the view expressed by Bombay High Court in CIT versus Manjula J. Shah, 16 Taxman 42, in case the cost of acquisition of the capital asset in the hands of the assessee is taken to be cost of such assets in the hands of the previous owner, the indexation benefit would be available from the year in which the capital asset is acquired by the previous owner. If this view is considered, the index cost of acquisition would have to be calculated by considering the cost inflation index of financial year 2002-2003.
Okay, so let's go back. Let's go to this thing. This property was acquired in which year? 2002, 2003. At what
Hmm.
price? 1,20,000. Now, the property became the property of Mr. A in 2006, 2007. Okay. The cost will be 1,20,000 to the previous owner, but we have to count for applying the cost of inflation index for the year 2006, 2007. But the court judgment says that you have to apply the cost of inflation index of 2002, 2003, which is the inflation index applicable to the previous owner. Okay. And not what we have done in this question. Okay, so what we have done is that we have applied, as 2002, sorry, we have applied 2006, 2007. But he says that it should be 2002, 2003 that should be applied. Okay, so we should apply 105 and not 122. Okay, as per the court judgment, because the property of the, Mr. The co-partner, Mr. A. The property became in 2006. His property, Mr. A became the owner of the property in 2006 and 2007. Okay. Of course, the cost is 1,20,000, which is given clearly in the law. But from which year the indexation benefit will be applicable? It will be in the year when he became the owner of the property or when the previous owner, the HUF became the owner of the property. The HUF became the owner of the property in 2002 to 2003, whereas Mr. A became the owner in 2006, 2007. Now, if you take the advantage of the court judgment, you can always apply the cost of inflation index from 2002 2003 instead of 2006 2007. So that is what it says. Let me just, as per the view expressed by the Bombay High Court, in case of the cost of acquisition of the capital asset in the hands of the assessee is taken to be the cost of such asset in the hands of the previous owner, the indexation benefit would be available from the year in which the capital asset is acquired by the previous owner. If this view is considered, the index cost of acquisition would have been calculated by considering the cost of inflation index of 2002 2003. So let's just finish this off. Let me just put this number here. So I just insert here one sheet, okay, and just copy this. So I'm just copying this, okay, and then you can ask me any question if you're not followed. Okay, is this visible?
Yes, sir.
So now I'm going to, even copy this on this side. or rather at the bottom I'll do. Fine. So this is the year when HUF bought this property. Okay. And this is the year. So this is the actual year of purchase. Year of purchase. What was the price of the asset? 1,20,000. Fine. So which we have used here, 1,20,000. Okay. Fine. And the year of partition. Fine. So the value it was transferred at 1,50,000, which we are going to ignore. Okay. Fine. Which we are not going to use at all. Okay. Now this is the year of sale. Okay. Fine. And it was sold at how much price? 15 lakhs. Okay. Now here what we are saying is that here what we have done is we have we have used this divided by year of partition into this value. Fine. So this was the value which was chosen, isn't it? And then this was the value, and this value was, if we add to this, and the capital gain is this. So this is the capital gain, isn't it? Now we can, instead of taking this, we can always take this also. For calculate. If we take the court judgment, okay, then so that means the capital gains will come to only 4,48,000. So if we take the income tax view, then this is the capital gains, 5,03,000. Here we have taken 2006, 2007 as the starting point, okay, and sold the property at 348. But if we take the court judgment view, so in that case, we can take the court judgment view, okay. Sorry. Then in that case, the capital gain will become, the indexation cost will become 3,97,000 and the capital gain will be 4,48,000. Have you got it what I have done? You sure?
Yes. Yes, sir, I got it.
What we have done, just explain to everyone, if you can.
So, sir, so the original, the HUF has acquired this property at 2002, 2003, and the SSC, which is the co-partner, has got this property at 2006 and 2007. He has
Okay.
made some improvement in that in 2007-8, and finally in 2023-24, he has the co-partner, Mr. A, has sold the property.
Okay.
But as of now, we have taken the cost of acquisition. The CII which we have taken was in 2006 and 2007, which is 122.
Okay.
Although the price was 1,20,000, which is the original cost that has been paid by the HUF. But after this, after the High Court's order, it said while calculating the index cost, you need to take the CII of the year on which the originally the
Previous owner
property
bought
has
it. Yeah.
acquired. Previous owner has acquired the property. So instead of taking the CII of the co-partner, which is 122, you need to take the CII of the HUF that
Yeah,
of the
absolutely.
previous year, and it has been acquired,
Yeah,
which is
which was
105.
105. 105. Yeah, absolutely.
Yes.
So if you take 105, then the capital gain is becoming for 448. But if you take, the year of 2006 and 7, which is the income tax view, okay, the department view, you have to pay tax. So you can, when
No,
you file a income tax return, you can file it on this basis, okay. When you file the income tax return, you can always use this, okay, fine, and pay
yes,
tax
sir.
of 4,48,000. So when the income tax people will call you, chances are only 5%. Then you show them the judgment of the Bombay High Court, and if they don't agree, then you pay the difference, and can even contest it in the court, okay? Because it is not a Supreme
Sir,
Court judgment.
this
Yeah, yeah.
one thing, this law has been given for only this case, na? Like HUF given the property to the co-partner and all those things.
If,
It
again,
doesn't apply on the it
yeah,
doesn't apply on the owner of different like I have sold the property to someone else, then
okay.
when that person will sell that property, the cost of indexation would be calculated on the other person's
Yeah. No, only thing is that you can apply this court judgment if your uh, facts are similar to to this matter. Okay. For example, you also a co-partner and you got this property. If it's almost matching your this thing, then you can apply it immediately. Okay. But the only thing is that if you are in the state of Maharashtra, then the income tax authorities they cannot do anything and they have to go by your view, because Bombay High Court judgment is binding on the Department of Income Tax Department of Bombay. But suppose if you are doing it in Delhi, then they may say that it's a Bombay High Court and they don't agree with that, because the Bombay High Court has not been challenged by the Bombay income tax authorities or the income tax authorities. Okay, so if you're doing in Delhi, then they can always say that it is not acceptable. Fine, but chances are that you may not get any demand. Chances are only 1 or 2% that you may get a demand. Okay, fine, but the matter should be almost identical in nature. Then only you can apply. Is that okay, Kishore?
yes, sir, got it.
If the matter is almost same, then you can take this benefit of Bombay High Court. But if you are in Bombay, chances are that you will be absolutely, there will be no demand on that. But if you are staying in any other place than Maharashtra, then the chances are those authorities may ask you to pay the difference based on the previous calculations which I showed you. Is that okay? Is this clear to everyone?